Will record-breaking cuts in production be enough to stop the oil price slump? Crude producers, led by Saudi Arabia and Russia, agree to the biggest ever reduction in oil for sale. So who will be most affected? This is Inside Story. Hello, welcome to the programme. I'm Bernard Smith. Factories shut, airlines grounded, cars and trucks off the roads in many cities under lockdown. Demand for oil has collapsed due to the coronavirus pandemic, and oil prices fell further when major producers Saudi Arabia and Russia couldn't agree on cutting output. Now they've set aside their dispute. OPEC and the oil cartel's allies agreed to a 10% production cut, the biggest ever. But the deal to switch off the taps by 10 million barrels a day still needs approval from Mexico.
These circumstances require swift and timely measures. All of our oil-producing countries must pool efforts to change the situation related to the substantial overproduction of oil in the world.
The US didn't take part in the OPEC discussions on Thursday, which are the focus of a meeting of G20 energy ministers on Friday. Some analysts say production cuts will hurt smaller nations that depend on oil money. OPEC and the International Energy Agency warned last month that countries such as Angola, Nigeria and Iraq could lose up to 85% of their oil and gas income this year. Let's introduce the panel. In London, Alex Schindler, President at Energy Intelligence, an oil and gas research company. In New York, Antoine Half, a senior research scholar at Columbia University. And in Johannesburg in South Africa, NJ Ayuk, Chairman at the African Energy Chamber. Thank you for joining us, gentlemen. Alex, simple question, I'll start with you. Is a 10% cut going to be enough?
Well, I think it's the best they could come up with at this point. I think any deeper than that was going to really stretch the producers' ability to actually deliver. So the group signaled 10 million is what they wanted to do, and they achieved it. So I think from what was possible, it's a pretty good outcome. Now, is it going to actually rebalance this market in the short term? Absolutely not. With the coronavirus hitting demands dramatically, the deficit for the second quarter and even the first half of the year is going to be massive. So 10 million is a good start, but it's not going to fix the problems.
Antoine, what do you think? Will it be enough? Won't demands decline less than the production cut, more than the production cut?
Well, 10 million is the target that's been announced by OPEC. I agree with Alex. That was probably the best outcome of the meeting. It's a very ambitious target. Some people might say it's too ambitious. It cannot be achieved. It's at the same time too low because the market needs more to rebalance. But we're going to see additional cuts probably announced today from the G20. And certainly we'll see reductions in the US driven by market forces, if not by political decisions.
And NJ in Johannesburg, for developing nations, is 10% going to be enough? Is it going to hurt them?
It is not going to hurt per se, but they understand that it is needed. The cuts, for example, if you look at Nigeria, look at Angola, you're looking at about 1 million barrels coming out of Nigeria. You're looking at about 100,000 coming out of Nigeria, and maybe another 70 or 80,000 coming out of Angola. It is going to hurt in the short term, but in the long term, it's going to be beneficial because the current prices right now, especially for developing countries like Nigeria, Angola, Equatorial Guinea, it's just not. It just doesn't help the country's budgets. It just doesn't help with jobs, and we already seen a lot of job losses. So we want even deeper cuts when you look at it from an African perspective.
Antoine, can I ask you, how eager would Saudi Arabia and Russia have been to agree big cuts? And I want you to explain a little bit about this Meanfield game theory analysis you've been writing about, which suggests that for the very strongest producers like Russia and Saudi Arabia, they can afford to ride this out and push the smaller ones and the shale producers out of the market.
This is a very exceptional crisis. I mean, this is probably the biggest oil shock that the system has received since the 1973 first oil shock. Although at the time in 1973, the price move was on the upside. This time it's on the downside, but the significance, the implications are, in my view, of similar magnitude. It's going to reshape the production map of the oil industry. It's going to change the system of governance of the oil system as well, in my opinion. But yes, the analysis that some of my colleagues in a company that I co-founded called Kairos have done, and they include a Fields Medal laureate in mathematics and some of his colleagues who have invented the mean field branch of game theory. Their analysis suggests that OPEC is not contrary to what it often says in the business of stabilizing prices. It's really in the business of optimizing revenues and managing two conflicting objectives, that of having a high price and having a high market share. Both objectives are incompatible. They're in conflict. Therefore, the market cycles through periods of price increases and dramatic collapses. The model was signaling for some time that we were about to reach a cliff moment when the price drops off a cliff, and that the large producers, the large low-cost producers like Saudi Arabia and Russia, were probably waiting for some kind of shock to get into cliff mode. The shock was the coronavirus. So I think what they've done, increasing supply in the face of the demand collapse, increases the impact and really has offered them a chance to drive off some of their competitors. I think they're achieving those objectives. The 10 million goal that was announced yesterday will certainly not prevent a further price drop or push the price back up. What it might do is postpone or avoid the moment when we run out of storage capacity. But the result, in any event, is that it's going to be much more difficult to finance oil production in some more challenged sectors, including in the US. And we're going to see some reductions, at least at the margin, in production capacity. So this will increase the market share of the large producers.
Alex, do you go along with any of that? This is coronavirus was the opportunity that Russia and Saudi Arabia might have been waiting for.
Yeah, I read Antoine's piece there, and I found it very interesting. And it did align with what a lot of the rhetoric was in the market, that this is the opportunity for the low-cost producers to actually deliver on what they felt was the only fair way the market should operate. Why should lower-cost producers shut in production and higher-cost producers benefit? And it's been for many years this way, and the coronavirus did give us this interesting opportunity. I think what happened here, and I think what we found out in the last week, is that Russia and Saudi Arabia in particular were not really prepared for that pain that it would have taken to actually raise their production to maximum levels and then see how low the price goes to drive out everybody else. So, the debate was over how long could these big producers manage at low oil prices. And, I think why this deal came together is that the big country said, you know what, it's not in our interests, even over a 6-month, 12-month period, to have prices be super low, even if that drives out higher cost producers. The economies, politically, economically, they just couldn't really face that reality. So, I mean, that's how I see it playing out, and why they've kind of come to the table, quicker than I think many had expected.
NJ, Nigeria set its budget last year, expecting a price of about $57 a barrel for oil. It's had to change its budget since. Nigeria, obviously Africa's subcontinent's biggest oil producer, can Nigeria ride this out? It hasn't got the luxury that Saudi Arabia and Russia have of big financial reserves, has it?
Of course they don't, and it's going to be very, very difficult for Nigeria. Nigeria, unlike Angola, they don't really have a big sovereign wealth fund that they can kind of use to shore up the economy, put some release, and really create that. What you see right here is that these African countries have to really rely on OPEC. They have to work with OPEC because they do see OPEC as a source for stability. But I think it's even bigger than reserves that they have. It's also looking at attracting new investment into fields that have to be developed. Some of them really clearly want to increase production and really create a new opportunity for them to see more oil or more gas. And I think this shift and this price war has really given us a new thinking, and not just when it comes to economic diversification, but diversification away from crude or a sole focus on crude, to really start looking at how we can play with gas and really seeing how gas monetization can really help us reshape the balance of the market. So budgets are tight. It is very difficult for most countries. And let's not just look at Nigeria. Let's look at Equatorial Guinea. Let's look at Gabon and look at Congo. But Africa is really taking a lot of heat because projects in Mozambique with ExxonMobil and others, they have been not been canceled, but been postponed or suspended. Senegal, that had great gas finds with BP and Cosmos, and some of they have all been postponed or delayed. And there's the same with Woodside and Kern. So we're really seeing the brunt around here, and we hope that this is really going to change. And when this happens, the African street just go into a depression, and the everyday Africans start losing jobs, and it creates a lot of social issues around the continent. So the different kind of expectations when compared to Saudi Arabia, Russia, or the Gulf states in the United States.
And Antoine, just back on something that Alex said before, do you think Saudi Arabia and Russia were caught out slightly by the scale of the drop in oil prices? They weren't quite prepared for it.
They practiced a policy of shock and awe. They tried to really shock the market, produce in the face of the downturn. But there's limits to what they could do. And actually, I think there were market and physical limits. Saudi Arabia has been shipping out a lot of tankers full of oil, but has had trouble finding customers for them. I think both countries faced problems, challenges that were not just financial challenges. I think they could withstand those challenges thanks to their financial buffers, but they just had trouble pushing more oil in the system. Saudi Arabia has increased production dramatically. We saw the response, the supply response immediately after the breakdown of the OPEC plus meeting on March 6th. So they were prepared to go into overproduction, but the market could only absorb so much overproduction. So I think that the time was right. The trick, the move played out. The rest of the world came together and agreed to cut production, and we're going to see another meeting today of the G20 to discuss further production cuts. So the objectives, I think, was achieved, but now it's time to pedal back a little bit and adjust to the reality that the market is getting saturated. And the storage capacity of the world is getting stretched as well.
And Alex, is a 10% production cut enough for the US shale producers?
Well, I think you're going to see, I mean, in the next week, we'll see how the US shale producers react. I mean, we've got the G20 meeting today where, we're going to have a lot of discussions around countries that are not part of the OPEC plus alliance to see how much extra they're going to be participating. I mean, we're hearing anything up to 5 million barrels a day more. But then next week is the kind of key week to watch for sort of U.S. shale producers on what exactly, or U.S. production in general, what they're going to be able to deliver, and whether they're going to deliver just the market forces impact of lower oil prices, the shut-in that will have to be shut in because prices are in the $30 range, or whether there's going to be more active management of the market, either through the Texas Railroad Commission and other states that are talking about doing something. But this is going to take, as we understand, about a week to sort of play out, because there's meetings that are going to happen at the 14th next week with the Texas Railroad Commission, and then sort of a final decision by the end of next week to sort of see how much the U.S. is really going to be able to commit actively or sort of just by market forces alone.
And NJ, the developing countries are almost side actors in this game between Saudi Arabia, Russia and the US. Do they have any leverage at all? They're the ones that are really going to feel most of the pain. Do they have any way to put pressure at all on anyone?
I think they're already putting pressure through membership in OPEC and OPEC plus. Don't forget the huge role Nigeria, Angola, Equatorial Guinea, they've played. The OPEC presidency right now is run by an African from Algeria. They have shaped, but when it comes to market forces, of course, that we don't really have that much when looking at how much we import and how much we use. China still come out as a big winner here because of the prices, but there has been a continuous push among African states on how this needs to go about. Not all the developing countries were very happy with the cuts and what happened at OPEC yesterday, but they united together, and I talked to many of them to accept it because they understand that if a more stabilized market, it's really good for us. But then what has happened is that they had the lessons learned from yesterday was a new focus on exploration and saying they got to increase their market share so that they can really play an active role in shaping this energy dialogue in the future. And that's a big lesson when it comes in creating that enabling environment so that you can be a player.
Antoine, do these developing countries have any leverage, or are they all out of the game and it's all up to Saudi Arabia and Russia? Can they do anything? Saudi
Arabia and Russia are really exercising a lot of influence and control in this situation. Of course, the primary driver is the pandemic, but the two countries, the superpowers of oil, the largest exporters, have really played their cards, in my view, quite well, and have made the most of these very difficult circumstances. To go back to the point you raised before, in terms of the response of the shale producers in the U.S., we're seeing a response today. The company I was mentioning, Kairos, I work with, monitors activities in the tight oil patch in the U.S. and monitors the rig count, but also the frac crews, the crews that go and do the fracking and complete the wells. We've seen a dramatic drop in frac crews, in the number of frac spreads active in the tight basins over the last month. We've seen a decline of 100 frac fleets active in the shale patch. That's a very dramatic decline. It's a 50% month-on-month decline, 60% year-on-year. And there's probably more declines coming.
And Alex, the US is going to be under some pressure to cut production itself. It, of course, can't officially do it because of antitrust laws. How could the US play its role in cutting production?
The Texas Railroad Commission, they do have the ability to sort of manage Texas oil supply. So I think if anyone's looking for active market management in the U.S., it looks like through the Texas Railroad Commission is the most likely way that could happen. Now, this mechanism that the Texas Railroad Commission has not been utilized for many decades. We don't really know how it would operate in a current sort of 2020 environment. But we do know that of the three commissioners that sit on the Texas Railroad Commission, at least one of them is very in favor of some active market management. You'll need 2/3 of the members to vote for it for something to actually happen. So it's a matter of convincing one of the other two to sort of go along with this. But if you're looking for active market management, it seems like this would be the most likely way it could turn out. Is it likely? I'm not quite sure. We're hearing different things. I think this one commissioner is quite optimistic. But again, the issues around antitrust, the sort of resistance by the oil companies, the sort of U.S. resistance in general to anything that isn't free market. It's a pretty tough thing to sell to the U.S. But we'll see. As we know, we're in extraordinary times.
And NJ, with oil prices at these current levels, what are the risks, the knock-on effects to other production projects coming up, particularly in sub-Saharan Africa?
Most of them are on risk. The number of force majeures are going up. If you look at Tower Resources, just announced force majeure in Cameroon earlier this week. BP announced force majeure on other projects, and that already put a lot of projects at risk, and a lot of exploration is at risk, and that is also something that you have to really look at, and you really have to doubt how we're going to survive throughout this period. But there's going to be hope, because exploration is still going on, and some studies are still going on. But the big ticket items, the big money projects, they also are being very, very strained. And one of the things that we have to really worry about is you have to really look at what is going on in offshore platforms with the coronavirus, because now companies are paying more attention to that, and they're not really trying to invest in a lot more projects. But for Africa as well, this is a great opportunity for us to really step it up and put some kind of reliefs that the companies need. Look at those fiscal terms, grant them extensions on PSCs where you need, because you really have have to use this as an opportunity to attract new investment and not kill projects. And we have to take it, we have to look inward and look at an enabling environment, create that framework for more exploration, but really show up African companies to use gas and to really look at it. It shouldn't be an opportunity to abandon local content or not to do some of the policies that we've been putting in place to really drive up employment and really drive up exploration. So you are going to see projects being delayed, but that's not all. We have to really get right back to it and really drive it. I think it's probably the same for Latin American countries or small producers around the world.
And Antoine, are we going to have an OPEC Plus meeting again later in the year to agree further cuts?
That's quite possible, but the whole system of governance is changing. So you see the role that the IEA has been playing, helping organize the G20 meeting. This is a very significant change. And there's going to be changes within the US as well. So part of the issue in the US in terms of whether or not to agree to production cuts announced and managed by the government at the state or federal level involves a conflict between the independent producers and the majors. The independents support production cuts. The majors oppose them. And they probably would not mind seeing the independents slow down their operations or put some of their assets for sale or put themselves up for sale. So there's a lot of restructuring going on in the potentially, and there was some consolidation and restructuring going on before the pandemic. It's likely that the recent developments will accelerate that trend and that we're going to see a reshaping of the oil landscape in the US as well as in the world at large.
And Alex, do you also foresee another meeting as the industry reshapes, another meeting further in the year for further cuts?
Well, I mean, OPEC is really good at dealing with the crisis right in front of them. And I think that this was the way of dealing with the crisis right in front of them. And I think if anyone would say they'd know what the situation looks like globally, economically, from the oil market perspective in 6 months, it's just impossible to tell, given that we're sort of at the heart of the coronavirus pandemic right now, especially in the West. So, I mean, there's always a chance of that you got to come back and re-examine market forces and see how things are going. And, are people adhering to the 10 million barrels a day? This is going to be a really important thing to watch. But, they will, OPEC is good at kind of responding to a crisis. And that's what we've seen this week, a major crisis, and they pulled off a pretty improbable deal.
NJ, I see you nodding away there. Do you see a further meeting later this year for further cuts? And can the developing countries sustain those?
I think there's going to be a meeting and there's going to be further cuts. There needs to be further cuts. President Trump, God bless him, he has not always been the biggest friend of OPEC. But I think with some of his most recent tweets, he's really encouraged OPEC to work. And I think that's a sea change when we look at the perspective of Washington and this president and how he has viewed OPEC. And I think now that's the education of the presidency gives to you in the United States. Now he's starting to see OPEC as a force for stability. OPEC is going to deal with this, as Antoine and Alex have mentioned. There is going to be likely another meeting because you have to really see a global cut. This is not going to be, without a global cut, this is not going to be successful. But one other thing you need to pay attention to is going to be compliance. How are we going to ensure and enforce compliance? And I think OPEC needs to get together within the next 60 days to, first of all, look at compliance, how we've managed that, and also look at U.S. independent producers. They need to come into the game. It can't be only us. They need to come in and they need to play their part. So does Norway and Canada, because in Canada right now, a pint of beer is more important than a barrel of oil, and we need to shore up this industry. Okay,
we're unfortunately out of time, gentlemen, but thank you to all our guests, Alex Schindler, Antoine Half and NJ Ayuk, and thank you too for watching. You can see the programme again anytime by visiting our website, aljazeera.com, and for further discussion, go to our Facebook page. That's facebook.com/AJ Inside Story. You can also join the conversation on Twitter. Our handle is @AJ Inside Story. From me, Bernard Smith, and the whole team here in Doha, bye for now.